now that 2019 is almost over, what should we do with all these beaten down IPO names that came public earlier in the year, only to become duds right out of the gate, or peak just not soon after?
House of Pain.
Sell. All right, before the IPO window closed, we saw dozens of deals that were simply too expensive to be enticing. Think Lyft, Uber, Smile Direct Club. We saw turbocharged growth names explode higher, only to come crashing down from irrational levels within months. Zoom Video, Beyond Meat, CrowdStrike. But here's the thing. As long as the balance sheet's okay, stocks actually do get cheaper as they go lower. And when it comes to the IPO class of 2019, most of them are down dramatically from their highs. So are any of them worth owning as we head into 2020? 2020 vision. Let me walk you through some of these names that have become enticing at these levels, or at least, let's say, make sense. We're going to start with none other than Levi Strauss. There are, just let me tell you, there are others that don't have mad money on them. But when I go to the store, this is all I see. Levi Strauss, the iconic jeans brand that kicked off the IPO deluge when it came public in March. And how great. I mean, come on. On its first day of trading, Levi, the collars. All right, okay, so I'm not. Hey, listen, it's just we'll do it. We'll fix it in post-production. Anyway, on its first day of trading, Levi zoomed from 17 to 22 and change. And at those levels, I thought it was too expensive. So I told you to hold off until we got a better entry point. Well, we did. We got a better entry point. The stock plunged to $16 in mid-August. And after some not-so-hot numbers, really not so hot. And since then, it's actually mounting a nice rally, climbing back to 19 change levels today. At this point, I think Levi's is still worth buying. We did decide, you know what, here it's just too enticing. That was a nice call. I mean, the stock currently sells for 17 times next year's earnings estimates. It's making one of the two turns cheaper than the average name in the S&P 500, but it's much better than those. It's a little on the expensive side for an apparel maker, but still, I like what Levi's is up to. The company has solid mid to high single-digit revenue growth and has developed a habit of beating Wall Street's earnings estimates at last. They're a terrific innovator. And as we know from speaking to CEO Chip Bergh at his innovation lab in San Francisco, where they've come up with a much more efficient way to manufacture jeans, well, you know what? I think it represents real ingenuity. This isn't just clothes anymore, all right? I think the forecast for 2020 and 2021 could prove to be low, which means Levi's likely has more upside going forward. And I just tell you that Matthew Boss, whom we've had on, he's the really good retail analyst over at J.P. Morgan. He thinks it's bottom too. Hey, speaking of denim, VF Corp spun off its jeans business, Lee and Wrangler, as Kontoor brands. It was considered to be a total dud initially. For months, I've been telling you that VF desperately needed to spin off its ailing denim division for its stock to go higher, which it is, by the way. But once Kontoor started trading, I realized it had a lot going for it, including a bountiful dividend that currently yields 5.6%. That's why I recommended this thing in July, and then since then, it's up 37%. Obviously, Kontoor is much less of a slam dunk after this move. But the dividend remains attractive, and it is still fairly cheap. It only sells for 10.6 times this year's earnings. I say stick with it, but remember, apparel seems to go up or down depending on Chinese trade talks and what you're hearing from, let's say, Gap stores to Nordstrom to Kohl's. Next, how about the ride-sharing stocks? Now we're dealing with Lyft and Uber. Lyft was the first huge IPO of the year, and it was a disaster right out of the gate, with the stock opening up at 87 and change before going to plunge to 78 at the close on its first day of trading. You know, it almost opened at 100. That would have been really bad. And it kept getting slammed over the summer as the market fell out of love with unprofitable but fast-growing companies. By mid-October, it had fallen to 37. But then we started hearing that both Lyft and Uber were committed to reaching profitability sooner than previously planned, certainly sooner than they would when they were on the roadshow. And that's why I recommended Lyft in November. They seem to be getting their act together, and the market had already digested a wave of new shares from the lockup expiration. And since then, it's rallied nearly 8%. I think the fundamentals here remain intact until something goes wrong or the stock goes substantially higher. We're going to stick with Lyft. It doesn't hurt that we're starting to see second and third rate ride-sharing companies go under, like Juno, which just referred all of its customers to Lyft. With the stock trading at roughly 3 times sales, I know you want it by earnings, but it's for sales. I think the valuation is actually pretty reasonable. Lyft delivered 63% revenue growth in the most recent quarter. That's pretty terrific. Then there's Uber. Lyft's larger, more troubled cousin. When I recommended Lyft last month, I told you to wait on Uber because the lockup on insider sales was about to expire. I figured that could really slam the stock price. Since then, there's been a wave of bad news. Former CEO Travis Kalanick has sold more than $2 billion worth of stock since the lockup expired. When I met Travis at the White House Correspondents' Dinner, the first thing he said was he was much richer than I am, which I felt smacked of hubris. There was a horrific safety report. Local governments all over the world are trying to crack down on the labor practices. They just got banned in Germany. I mean, tons, right? But you know what I got to say? Uber, the stock, has done an incredible job of hanging in there, especially the last few weeks. Consider that it did it under the onslaught of a man who's much richer than I am, Kalanick, dumping all that stock. Plus, I like that they're selling the ailing Uber Eats India business. I wish they sell the whole darn thing. If they were to simply close the unprofitable Uber Eats, the stock could soar. I still prefer Lyft, but I suspect Uber may have bottomed here, especially if they bite the Uber Eats bullet. Next up, we've had a bunch of cloud-based software IPOs that soared right out of the gate, then ran out of steam in August and September. Now, unlike the more established peers, some of these stocks haven't bounced. And you know what? Well, let's just say they're still kind of hanging out down there. Take Zoom Video. Now, this is a cloud-based video conferencing platform. It is so good. It came public at 36 in April. For opening for trading at 65, and then it peaked at $107 in June. Then the whole cloud cohort went out of style on the Wall Street fashion show. So this thing zoomed right back to the low 60s by late October. And just when the stock started to get some lift, Zoom reported a quarter that was widely considered to be disappointing. I didn't think so, but the Wall Street didn't like it. That was a couple weeks ago, and that's why it's still stuck at 68. Now, Zoom has, almost everyone would admit, except for maybe people at Cisco, the best technology. We use this at the street for my monthly ActionAlertsPlus.com conference calls. I love it. I believe in CEO Eric Yuan. He's come on the show a bunch of times. And while the growth has slowed a bit, it's still pretty spectacular. It's up 85%. In the latest quarter, the problem is that Zoom is still darn expensive. 22 times next year's sales, not earnings. 16 times the fiscal 22 forecast. I can't countenance buying that at 40 or even 50. Now, Zoom, let's just say it would still be expensive, but I could recommend it. At 68, it's just too rich for me. It's one of those things, since you got to understand this, people, just because Zoom, the product, is the best, Zoom, the stock, can be too expensive. And then there's CrowdStrike, the cloud-based cybersecurity play. This story is remarkably similar to Zoom. You have a great company with an incredible product, but the stock's been too expensive from the get-go. The difference is that CrowdStrike's now down 22% from where the stock first opened, selling for 12 times its fiscal 22 sales estimates. Still too pricey for me. Remember, I like at times earnings, not sales. But if you want to take a small speculative position, you got my blessing. Good product, good company, stock down, CrowdStrike. What else? Pinterest had a red-hot debut, but then it turned out that the company was much further from profitability than we thought, and they became a serial disappointer. While the stock's down to its IPO price, I think you need to stay away until they demonstrate more rigor. Revolve Group, the web-based fashion retailer. Good story. I made the error of recommending it in August, right before the growth went out of style. Bad. Stocks now pulled back from 42 in June to 17 today. It's absurdly cheap, frankly, selling for 17 times the 2021 estimates, and that's just ridiculous. I mean, this thing's got great growth. I think it's going to be a terrific stock in 2020. Revolve. Maybe one of my favorites in this whole segment that I'm talking about. Bottom line, this year's IPO market has been a real roller coaster, but now that the dust has settled and many of these newly minted stocks have come down, I got to tell you, I like Levi's. I'm not going to put it on because it was really tight, and then I got the collar wrong. Kontoor, Lyft, and Revolve right here, right now. Oh, and one last piece of advice. Will you please stay away from Chinese IPOs? They are bone crushers of the first order. Let's speak to Mike in Florida. Mike.
Hey, Jim. Thanks for having me on. I'm calling about Slack. I picked it up about 90 days ago. It keeps bouncing around between 20 and 25. I was hoping it was going to break out. I'm watching its competitor, Microsoft, take off. I was wondering if you think Slack could break out in 2020 or get rid of it.
Well, this is the problem with Slack. Everybody knows it's the best product. Everybody. But they came public in one of those, what I regard as being novel ways, where you didn't have real price discovery. And then the company is forever looking over its shoulder at Microsoft. Slack's good. It's just not good enough. Whoa! The IPO market has become a roller coaster. but I think the dust has started to settle. I like Levi's, I like Kontoor, I like Lyft, and most of all, I like Revolve. Much more Mad Money hit. The opioid epidemic has contributed to more than 700,000 drug overdose deaths in the U.S. since 1999. I'm talking to one CEO who's behind a tool that is working to save lives. Then the future belongs to artificial intelligence. I'm eyeing one private company that's using that trend to its advantage. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.